We'll be going over IRS Form 4797, Sales of Business Property. Taxpayers will use this form for a couple of reasons, primarily to report the sale or exchange of certain property used in business, in your trader business, such as real property, depreciable and amortizable, tangible property, oil, gas, geothermal and mineral properties, or Section 126 property. This form is also used to report involuntary conversions of property used in your trade business that were held for more than 1 year, the disposition of non-capital assets, disposition of capital assets that are not already reported on Schedule D, the gain or loss for partners and shareholders of S corporations from certain Section 179 property disposition, recapture amounts under either Section 179 or Section 280F, or gains and losses treated as ordinary gains of trade gains and losses if you are a securities trader or market in commodities and you made a mark-to-market election. Finally, you might use this form to defer a qualified Section 1231 gain invested in a qualified opportunity fund. This might not be the only form that you have to file based on the circumstances of your disposition of property. So you may need to use IRS Form 4684, casualties and thefts, if you're reporting any involuntary conversions due to a casualty or theft. You may need to use IRS Form 6252, installment sale income, to report the sale of property under the installment method. You may need to use Form 8824, like-kind exchanges, to report exchanges of qualifying business or investment property. And if you sold property for which you received an investment credit, then you may need to file Form 4255, the recapture of investment credit. Depending on the nature of the property you're selling and your holding period, you can see in the form instructions which parts of the form you may need to fill out. So quickly, before we get in depth in the form, there are 4 parts to this form. It's a 2-page form. Besides the version of the line 1 information at the top, there is part 1, which is sales or exchanges of property used in a trader business and involuntary conversions from other than casualty or theft. Most of property held for more than 1 year. There is part 2, which is ordinary gains and losses, generally property held for 1 year or less. Part 3, gain of disposition of property under certain sections of the tax code. We'll go through them a little bit more detail. And finally, part 4, which is recapture amounts under sections 179 and 280F when business use drops to 50% or less. So based on your tax situation, you may not need to use all of these parts, but we're going to go through them in order, starting at the very top of the form. So we're going to enter our taxpayer's name. We'll pretend that our business owner is John Smith. He is a sole proprietor. But realistically, this can be virtually any taxpayer. So it can be a business. Most likely, it's a business. It can be a state trust. It can be partnership, or or a form to the partner itself. There are special rules that you may need to pay specific attention to, and there's more detail in the form instructions. So we're not going to go through those special rules here. I'm just going to list them out. So if any of the following may apply to you, then you should refer to the form instructions for more details. So at-risk rules, if you're reporting a loss on an asset for which you are not at risk, you may need to also complete Form 6198 at-risk limitations. There are special rules that apply to depreciable property and other property disposed of in the same transaction. Disposition of depreciable property that was not used in your trade or business. Partial dispositions of maker's property. Disposition of assets that constitute a trade or a business, installment sales, mark-to-market elections for traders, the sale of a home that was used for business. There are certain tax rules that you may need to be familiar with on how to report the sale of a primary residence that was also used for business purposes. Involuntary conversion of property, passive loss limitations, which may require either Form 8582, passive activity loss limitations, or Form 8810, corporate passive activity loss and credit limitations. Deferral of gain invested in a qualified opportunity fund, exclusion of gain from qualified community assets, exclusion of gain from the sale of DC zone assets. So if any of those situations apply to you, see the form instructions for additional information. Now, before we get into part one, we're going to talk about line 1 first. So in line 1A, you're going to enter the gross proceeds from any sales or exchanges that were reported to you on a Form 1099. Either 1099B, your brokerage statement, or 1099S, a substitute statement. And that you're either going to include here on line 2, line 10 in part 2, or line 20 in part 3. So let's just say that we've got $150,000 of proceeds. Now, for the purpose of this, we're going to move down to B and C. We're going to enter the total amount of gain that you're including on lines 2, 10, and not 20, but 24, which happens to be the total gain right here for items in part 3. Okay, so due to the partial disposition of maker's assets. So there is a section in the form instructions that specifically discusses partial dispositions of maker's property. So if this applies to you, please refer to the form instructions. In this case, we're going to put zeros here. We're just going to assume that there were 3 different properties here for illustrative purposes. We're going to go through one property in part 1, one in part 2, and one in part 3. But none of those had any partial dispositions. So we're going to pretend that we're selling a piece of we can use part 1 to report any section 1231 transactions that are not required to be reported in part 3. So you know what? Let's go to part 3 first. And we're going to report one piece of section 1250 property. We'll just say that this was a piece of rental real estate. And we acquired this back in 2020, and this is a 2022 tax form, so we'll just say that we sold this on 6/30/2022. And before we go too far, we're going to say that we sold this for $50,000. Now let's go to part one. And this is, we'll say that we had another piece of rental property that we sold that. But we bought this one in 2021. And they sold this on the same day in 2022. And we sold it for $50,000. Now, you'll go through the depreciation worksheet to figure out the depreciation allowed or allowable since acquisition, right? Residential rental real estate has a depreciation method of 27.5 years using the mid-month convention. We're not going to do the math in this particular scenario. We're simply going to come up with our own figure. But in your situation, you're going to actually have to sit down and go through the math on depreciation that was either allowed or allowable during your holding period. Now, for ordinary gains and losses, items that were held for 1 year or less, you may not always include any depreciation. It depends on if you were able to take depreciation during the tax year in your holding period. So, for example, we used the mid-month convention when we put this property into service. So basically, we were able to capture some depreciation at the tail end of 2021. We wouldn't have captured any depreciation in 2022 since that's the year that we sold this property. So let's just imagine that we did take $1,000. That was what we were allowed to. I guarantee you that is not the correct number, but we're going to use that as a placeholder. So in part two or part one, we're also going to put a piece of property here. Let's see what we can put. We sold some cattle. I don't know what a head of cattle goes for. We'll just say that it goes for $1,000 each. And since the required holding period for cattle and horses is 24 months for preferential long-term capital gains treatment, we're going to use that as our convention here. So if we sold everything on 6/30/2022, let's back this up and say that we bought these cattle in the middle of the pandemic. And we sold them for $50,000. And now you can take depreciation on livestock. So we're going to just say that the depreciation that was allowed was $5,000. I'm not going to look that up. I'm simply going to put in $5,000 as a placeholder for right now. Now in column F for part one, we need to insert the total cost or other basis of this property. So let's just imagine that we bought these cattle 2 years ago for $20,000. So for column G, it's pretty simple. They give you the formula right there. You're going to add this number plus this number. That gives us $55,000, and then we're going to subtract F, and that gives us $35,000 as our gain. Now, in line 3, we would need to determine if there was any gain that we would be required to report on IRS Form 4684. And for the purpose of this, we're going to say no, because these were not stolen cattle. These are not casualties that we declared insurance. But if we did recognize a gain for insurance purposes, then we would have to report that here. IRS Form 4684 being the casualty and theft reporting form. For line 4, we're going to enter any Section 1231 gain from installment sales, and in line 5, we would enter any gain from like-kind exchanges, and again, neither of those apply to our situation. Now, let's take a look really quickly at line 32. So line 32 happens to be the summary of all Part 3 gains. So we're going to need to complete Part 3 before we get back to this part up here. And so this is kind of where we're going to have to put this on hold for momentarily. We're going to go through Part 2 and then Part 3. Once we get the answer we need in Part 3, we can circle back up to Part 1 to complete this section, right? So we're going to pause right here on Part 1. And I'm actually going to put these X's here to keep my place, to know that I need to come back and revisit this. So let's go on to Part 2 and complete this row right here. So we are selling a reporting the sale of a rental real estate property B that we bought and sold 9 months later. We'll just say that the cost of this was $20,000. So same thing here, we're going to add column D and column E. We get $51,000. We're going to subtract column F, and that gives us a $31,000 gain. Now, if there was any loss here, we would put that here. Any gains in column 7, we would put them here. Or if there's an amount here in line 8, which is non-recaptured net Section 1231 losses from prior years. So because we can't complete this part until we complete Part 1, and we can't complete Part 1 until we complete Part 3, we're going to go down to Part 3. Now, we should be able to do this, right? So before we go through the entire section of Part 3, it would be good to take a quick look at each of the different code sections that we're required to report under Part 3. Now, if you remember, there are very specific code sections of property that we need to report here as opposed to somewhere else, right? So the reason we're reporting rental real estate here under Part 3 is because it's considered Section 1250 property. It's required to be reported here. Livestock would be different property, and that's not reported in Part 3. It's reported in Part 1. So for the purpose of Part 3, We're just going to quickly review some of these sections. So in line 25, we're talking about section 1245 property. This is property that's depreciable or amortizable or treated as amortizable under certain code sections and is the following. It's either personal property, it's elevators and escalators placed into service before 1987. It may be real property with certain amortization or deductions contained in the form instructions. For example, expenditures for child care facilities, amortization of railroad grading and tunnel bores. It can be used for tangible real property, single-purpose agricultural structures, railroad, storage facilities. So very specific requirements for using 1245 for certain real property. Generally, most real property will be reported under line 26. So that is section 1250 property. It's depreciable real property other than what is listed in section 1245. So 1250 property recapture generally applies if you used an accelerated depreciation method, if you claimed a special depreciation allowance, but it does not apply to dispositions of certain makers' property placed into service after 1986. So, but for the purpose of this, we would use it for, say, 27.5-year residential real property. So when we're selling this rental real estate, we're going to use the row 26, section 1250 property. Now for line 27, section 1252 property, you can skip this section if you're a partnership or if you did not dispose of any farmland during the tax year. For 28, unless you're in the oil, gas, or geothermal energy business, you can skip line 28. And then line 29, section 1255 property is generally used under certain percentage of payments methods. So you probably will not use this. There are form instructions that will kind of guide you to when you would need to use line 29. But generally, section 1255 property contains percentage of payments that were previously excluded from income under section 126. So if this doesn't apply to you, you can skip it. For the purpose of this illustration, we're going to use just line 26. So we're going to pretend that we had a $25,000 cost basis. We're going to say that over the course of this time, we were able to depreciate $5,000 of the property, in which case we're going to subtract line 22 from line 25. Our adjusted basis for this purpose is $20,000, which means that our total gain is $30,000. So now if we used straight line depreciation, then we would enter 0 on 26G. If you used accelerated depreciation, then you will have to go through this math right here. So I'll do this for illustrative purposes. Just know that if you use straight line, you can skip right down to the bottom and put in 0. So let's just say that we had $2,000 of additional depreciation. The applicable percentage under line 26B multiplied by the smaller of either this one, or 26A. So let's go into the form instructions. It says generally use 100% as your percentage here. However, if there are certain low-income rental housing, as described in section 1250, then you would use the percentages outlined in either clause 1, 2, 3, or 4. So we're going to say that that doesn't apply and that we would just use 100% of this $2,000 number. So now we'll subtract 26A from line 24. It just forces us to kind of maintain this, what the right basis would be. So if there's any additional depreciation after 1969 but before 1976, you would add that in row 26D. You'll enter the smaller of either 26D or 26C. If there's a section 291 amount for corporations only, you would put that in a line 26F. Generally, the amount that a corporation treats as ordinary income is 20% of the excess depreciation. And then you would add all of these lines. So 26B here, 26E, and then 26F, and you would come up with $2,000, right? So that basically is the additional depreciation. So we're not going to do that. We're simply going to go back to 0. Okay. I'll walk through briefly each of these other sections. If this were section 1245 property, then you would enter the depreciation allowed or allowable from up here. So this would be $5,000. Then you would enter the smaller of either this or this. Okay, so this would be $5,000 here in line 25B. If it's 1252 property, you would enter your soil, land, and water clearing expenses, and then you would multiply that by the applicable percentage noted in the instructions. So for the first 5 years, this would remain 100%. Then for each year between year 6 and year 9, it goes down 20%. So 80% if the farmland was disposed of within the 6th year. In the 7th year, it would be 60%. In the 8th year, it would be 40%. And in the 9th year, it would be 20%. And then after the 9th year, then it would be 0%. And you can skip the entire line 27 if you're selling this at year 10 or later. And then you would enter the smaller of line 24, line 27B. For section 1254 property, you would enter all of your applicable drilling and development costs, development for mine expenditures, mine exploration costs, depletion, everything there, and then you would take the smaller of that or the adjusted basis. If it was line 29 and you're doing section 1255 property, then you would apply the applicable percentage of payments that were excluded from income under section 126, and then you would enter the smaller of that or the adjusted basis. So we go through all of that and we come up to the total gains for all properties that we're going to summarize in line 30. So add all the property columns line 24, right? So here, 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 and here. So $30,000 would be our number that goes here. Now you're going to add line 25B, 26G, 27C, 28B, and 29B, basically the bottom of all of these. Okay? So we don't have any additional depreciation, but we're also going to enter this number back up on line 13. So we've succeeded in completing at least one part of this of part 2. And then you're going to subtract line 31 from line 30. So this would be $30,000. You would enter the portion from casualty or theft on your casualty or theft form, 4684. We're going to enter the portion from everything else back up on line 6 at the top of this form. Now, before we leave part 3, because this is the end of this part of the form, you'll note that there are 4 rows to describe your property, whether it's section 1245, 1250, 1252, 1254, 1255. If you need more than 4 rows, then you would need to use an additional form. So property row A, B, C, and D, correspond to property A, B, C, and D, which happen to be the 4 columns in the rest of the section. So let's take this $30,000 number and go up to line 6, which is where we put the X's. So now we're going to combine lines 2 through 6, and we've got $35,000 plus our $30,000. That gives us $65,000. So we're going to enter that on line 7, and then based on our taxpayer status, we would report it in the appropriate place. For partnerships and S corporations, you would report it on your Schedule K. So for partnerships, filing form 1065, that would be on line 10. If you're an S corporation, then this would be on Schedule K, line 9. And if you're a partnership or S corporation, you can skip lines 8, 9, 11, and 12 below. Okay, because you won't have any of that information here. For individuals, partners, S corporations, all other shareholders, if this is 0 or a loss, then you would enter this amount on line 11 below, because that would be a loss, right? So if this was negative $65,000, then you would carry negative $65,000 down to line 11. And then you could skip lines 8 and 9. Since this is a gain, then you're going to enter the gain from line 7 as a long-term capital gain on Schedule D, and then you're going to skip this, and line 11 and line 12 here, okay? But what if we did have non-recaptured 1231 losses from prior years? Let's just say we had $5,000. So in this case, now we need to subtract the $5,000 from the $65,000. This gives us a net total of $60,000. Now, if this is 0 or less, you can enter 0, but and then you would enter the gain from line 7 onto line 12 below. But since line 9 is more than 0, we're going to take this amount, we're going to put it on line 12. And then we're going to enter the gain from line 9 as a long-term capital gain on Schedule D. So this is your long-term capital gain. We recaptured this depreciation, which translates into a gain for ordinary gains and loss purposes. So now like I said, we've captured this $60,000 long-term capital gain. That's from the sale of the 50 head of cattle plus rental real estate property A that we calculated in part 3. Now we need to incorporate this $5,000 ordinary gain that we really recaptured depreciation, and we need to go through the rest of this. So we're going to go through part 2. We didn't have a loss on line 7 because we reported a gain. And it's important to note that if you have a loss, you can only have a gain or a loss on line 7. So if you're reporting a gain on line 12, you should be reporting 0 right above it. We already reported a 0 for the gain from line 31. Now we're on to line 14. If there's a net gain or a loss reported on your casualty or thefts form, you would report that here. For this purpose, we're going to say that no casualty and losses, no installment sales, and no like-kind exchanges for lines 15 and 16. Now we're going to combine all of these lines. So starting with line 10, where we had a $31,000 gain plus the $5,000, and that gives us $36,000 gain. So for every tax return except for individual returns, you would simply enter this number on the appropriate line of your return, and you can skip line 18A and B. But since Mr. Smith is a sole proprietor, we need to go through line 18A and line 18B. So line 18A states, if the loss on line 11 includes a casualty and theft loss reported on Form 4684, you would enter that part here. Then you would enter the loss of income producing property on Schedule A, line 16. Since that doesn't apply to us, we're going to put 0, and then we're going to redetermine the gain if there was, or excluding the loss. So since there wasn't any loss, we can simply state that the gain is the same as it was. So basically line 18 needs to incorporate line 35 from the casualty and thefts form to recalculate any possible gains. So real quick for reference, 4684, line 35, column B, happens to be your total losses for casualty or theft of property held for more than 1 year. But column 2B2 specifically is for income producing property. So you would only include the income producing property here, not necessarily losses or casualties from thefts of property used in your business, rental, or for trade. So now we've captured a $36,000 ordinary gain and our $60,000 long-term capital gain. Now in part 4, we're simply going to use this section to recapture amounts that were either deducted or depreciated in prior years. I would say that Section 179 generally would not apply to most of the depreciation that we had. I guess you could take a Section 179 deduction for your livestock, but generally we'll exclude that. But in the form instructions, specifically, you would enter, in column A, the Section 179 expense deduction. In column B, the depreciation that was allowable in prior tax years. In line 34, you would enter the depreciation that would have been allowable. You may need to refer to IRS Form, Publication 946, how to depreciate property, to calculate that. In column B, you would enter the depreciation that would have been allowable if the property had not been used more than 50% in a qualified business. So remember, you're depreciating this only if your business use of this property drops to 50% or less. So in our case, everything was used for the business, and we did not need to use Part 4 to recalculate. But this would be something that you might have to calculate if you took Section 179 depreciation on a business car that you converted to personal use, for example. And then line 35, you would simply recapture by subtracting line 34 from line 33. So the form instructions basically kind of walk you through what you need to do should the business use of your property drop to 50% or less, and then you have to recalculate the depreciation that you are entitled to so that you can recapture it and then put that in your taxes. So the line 35 report, then based on which tax return you're filing, then you would have to report that. So if you took a deduction, for example, our proprietor probably took his deduction on either Schedule C or Schedule F for farm property, then you would have to go back to that Schedule C or that Schedule F to report the recaptured depreciation. So that's all we have for this form. It's a pretty challenging walkthrough, and it's not linear, so you may have to jump back and forth, particularly if you have gains and losses in different sections. So if you have something that you need to dispose of under these sections listed in Part 3, then you would need to do Part 3 first, then circle back up to Part 1, which is property held more than 1 year that doesn't qualify under Part 3, and then Part 2, ordinary income, basically short-term capital gains and losses. So if you want step-by-step breakdown of everything we discussed here, you can go to our website. Simply go to teachmepersonalfinance.com, type in IRS Form 4797 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter. If you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions, comments, or concerns, please post them in the comment section. Thank you very much.